Thank you, Dr. Drake, and welcoming Mr. Steiner to the partners, longstanding partners at Hedgeye, who are rolling through this deck with me this time. I'll get into it with you first. Thank you for all that you do for us from a business and relationship perspective. We sincerely appreciate it, and welcome to Quad 2 and Q2. It's been a nice start to the year, certainly, and a nice start to the new quarter. We're not off this horse yet, and 100 slides from now, hopefully I can tell you why. Let's start with as we usually do, the process, but let's respect the machine here for a little bit of time, just to get back to where we've always started. If you go to the first slide in this deck, this investment landscape that we're trying to navigate and how it can frustrate you, excite you, et cetera, et cetera. You know, the flows and these expected factor exposures that should work when growth and inflation are indeed doing what they're doing have led to certain factor exposures being crowded, others being misunderstood, some being basically avoided, and we've had some short-term and what I call episodic and non-trending volatility periods in the U.S. equity market in particular this year that have looked nothing like the cycle itself. So you've had an opportunity as a full cycle investor, he or she on the next slide who's trying to capture that sine curve, the entirety of it. If you're the greediest, most capitalistic person on the earth, and I'm not far away from it, that's what you would do. You would capture the whole sine curve, from revenue growth to cash flow growth in the case of the pods. Those are company pods, or the quads, growth and inflation, of course. So again, it's not an easy thing to do, or everybody would be doing it. But again, if you can capture that full investing cycle, what you do with those short-term squeezes in high short interest stocks, or breakdowns in momentum stocks, or breakdowns in widely held low beta mega cap stocks, all you had to do was buy the damn dip, right? So you had opportunities, and you've had plenty of opportunities. I don't know how many more you're going to get like those in particular, but it does quite excite me. And we look at this obviously fractally and stochastically. Fractally and stochastically, as opposed to the way a lot of other people do it on that other triangle that we're showing there. Now, just right into the quads, for those of you that don't know what they are, pretty simple model, a 2x2 model. We built it ourselves, so you can look at it for what it is. We're going to the top right corner. Top right corner is where, in hockey speak, if a kid puts a puck up there, that's where grandma keeps the cookies. Right up there. It's the best it's going to get when it's that far up into the top right. On projections, if you go to slide 13, we're at 11.61 now on the GDP nowcast. So again, that's going to be the best number probably you'll ever see in your career. And if we see one like that again, that means that we will have seen the worst numbers you've ever seen in your career, because that's what gives birth to the best numbers. Again, I built this way, going all the way back to when I was an analyst, a little newbie on the buy side back in the year 2000, 2001, 2002. I'm like, wow, the 2-year comp or the 2-year base effect, John Dawson, this thing really matters, doesn't it? Yeah, you're coming off the easiest base effects or 2-year comps that you're ever going to see. So that number is obviously great. Directionally on inflation, slide 15, it's much more about the direction than it is about nailing the number to the decimal point. Now, to the decimal point, we're at 3.08, okay, currently for inflation. And again, it's the path going there. It's the entropy that occurs on the way there. It's exponential. It's not linear. So whoever's using some kind of, I don't know, some kind of regression model or some kind of a relative value against rates model, that's not what we do. If you want to do what they do, you do what they do. But I'd submit that what we've done on interest rates, going back to 2016 in particular, when I toggled this thing the right way, is we've gotten rates right big time, because we've had rates right because we got inflation right. If you get if you back test it, the longest term back test and indicator to get right for the 10-year yield is headline CPI. So that's why we're front running that and enjoying that quite a bit. And I ask myself the question often, like a lot of people talk about, oh yeah, we got to get to 2. No, that's a 3. Okay, we're going to get to 3, and it's going to happen really quickly, just like getting knocked out in a fight. Bang, bang, pop, pop, bang. That's the way that I think it's going to go. Woo. And why do I think that? Like, why wouldn't I think that? The next slide, if you look at our nowcast model and all the updated data points, of course, this is a trivial matter. You just drop the incoming data point into the model, and there you go. Voila. They're all green. Okay, February to March, and wait until you see the May numbers. Okay, April and May in particular, the April numbers that will be reported in May, it's going to be just bright green. And what you find is, on the way to the brightest of green, markets like that. So again, just pay attention to that. Bond yields like it too. And by the way, whoever thought that stocks wouldn't go up when interest rates did, that was I was only dead wrong. So let's not go with that or all the stories embedded in non-back-tested narratives like stuff like that. Slide 20, where are we at? Now, there's one of these things that's not like the other. That's China. So obviously we went bearish on that already. So we're going to stay that with the card count at 333 on yellow. So those are yellow lights. As a reminder, what is quad 3? That is stagflation economically. That is not good. That's where you get multiple compression on equities. So if you're looking at cheap and cheapening Chinese equities, you should expect more of that. And then, of course, in quad 4, if you want to try to front run me, a lot of people do. Hopefully you didn't do it 2 weeks ago, but at the end of the day, at the lows of the Russell or the NASDAQ for the year, that was not good. Okay, that did not end well. Okay, so at the end of the day, let's stay with the process and understand that this, when it ends, it's going to end, and hopefully I get that right in terms of timing. Next slide, where we're going next, again, doubling down, tripling down, whatever you want to do, just buy the damn dip on quad 2. We'll review that. Macro signals and divergences. So the number one question should be, or at least in most client calls, is when is it going to change? Well, I mean, I focus on that from 4:30 in the morning till I go to bed every single day. So I'll show you that. And then, of course, Steiner's going to hit on rates and housing and whether or not we're seeing peak cycle in both. Slide 27. So let's just get going here with our commensurate cartoon. And then quad 2 in Q2. You don't have to overthink it yet. Okay? Now, again, the comps, and that's the thing, the easiest comps in the history of your investing career are upon us. So the consumption comp, the manufacturing comp, these are down like in the teens, okay? Those are what we haven't yet comped against. So if you thought that the numbers look good so far, wait until we comp those numbers. Labor comps, obviously durable goods comps. 4-decade highs, that's a long time. I mean, I'm 46 years old. I wasn't doing this when I was 6, but at the end of the day, if I was, I'd still say that's a 4-decade high, right? So these numbers are awesome. The ISM closed the first quarter with the headline at a 4-decade high, new orders at the highest since 1982, okay? And supplier delivery times at the highest since 1974, okay? So for those of you that are 45, 46, that's a long time. That's a really long time, and ever is a long time. We're not at ever yet on that one, but we are at some others. Manufacturing activity, that will remain strong, so we're showing you the pipeline as a leading indicator. That's a great chart if you want to start throwing around some charts that people aren't looking at all the time. The inventory cycle, party just getting started. We already talked about this, obviously, in November and then again in January. So we've been saying the same thing, but now the data is doing the things that we proactively predicted it would do. So again, ISM backlogs. And then if you really look, I mean, this chart in particular, when you look at backlogs at multi-decade highs and inventory to sales ratios at cycle lows, there's only one way for that chart to go, and it's not down, okay? So that, I think that dog will hunt. And at the end of the day, that's why I've stayed a little bit like Icarus. Some days I feel like Icarus, flying a little too close to the quad 2 sun. But it's okay. It's okay. It's not an easy thing to do, and I'm feeling all right doing it. This is the most important point on what I would have been most concerned about 3 months ago. I didn't know. I don't know anything. All I know is the last data point and the last market price volume and volatility signal. That is all I know. The 8.5 million payroll deficit is flipped from structural risk to upside opportunity. Okay? And again, we understand that structural risk remains. But what a lot of people don't understand is that their theories on structural risk can be trumped in a very painful period of time in cyclical time, cycle time, market time. Okay? So pay attention. If that's right, or anywhere close to right on those green bars, those upside opportunities are to the bulls indeed. And again, consensus certainly isn't bullish enough on that. I wasn't. Now I am. Maybe you could debate that. Income recovery. Obviously, if you look at private sector salaries and wages, nothing's changed there. Confidence versus savings. This is a big one. And again, it's a savings rate that Americans really want to have. They don't save. No, they just have a lot of cash. Yeah. So think about it. I mean, at the end of the day, confidence is there and the savings are there, so what do you think they're going to do? Now, next slide. Excess savings, we talked about this last time. That's $1.9 trillion before the checks. Big checks. Remember Mnuchin? Those checks weren't big. These are big checks. So again, for context, excess savings is like greater than 40% of retail sales. 40%. Inclusive of the March stimulus, it's probably closer to 50, okay? But just internalize that for a moment. Just like take it into you in terms of the deliberate study of that. Huge. We don't know how huge. Trump couldn't tell you how huge. So again, if I sound bullish, you know when I'm bearish, I sound bearish too, so it's fine. What's changing? The consumer is telling us this. These numbers, again, they keep getting better. That's an expectations chart, looking 1 year ahead. I think Todd Jordan said on the morning call this morning that like 87% of Americans have a trip booked already. Booked. They want to get out of their house. Yes, you don't know what that's going to look like. You can't tell them what to do. Some people want to tell them what to do, but how about the brrr? What comes next? Oh, yeah. Now, this is exciting, right? While this is happening, I think they call it innovation. Okay. Now, as you know, I'm no Federal Reserve fan, but let's just rattle off some points. The March stimulus checks, like I said, are not in our nowcast, not in the data yet. We nowcast as data comes to be. The checks will continue monthly. Households will begin to receive these things. Obviously, enhanced CTC, if you don't know what that is, that's the child tax credit. And then for those of you that are big in infrastructure, you got $4 trillion there. And then you got student loan forgiveness, like first-time home buyer tax credits and stuff like that on the horizon. Ooh, goody, goody, goody. All right. Reflationary policy, again, this is interesting. We get most questions about this after the dollar goes up and then reverses. But I mean, the fact of the matter is that the deficit's been for a long time a great leading indicator for the dollar. You print lots of money, you devalue your dollar, it goes down. Now, X, the economy being in quad 4, that's when the dollar stabilizes and strengthens. But from here, I mean, from last week's local high that we signaled as immediate term trade overbought within a bearish trend, which I'll show you in a second, the dollar could get pounded. And consensus is long the dollar. CFTC futures and options contracts. You saw that, okay? So let's be wary of that. Don't forget quad 2 momentum's global. Everyone knows that, I think, ex-China. And positioning, we're just going to ring the bell. Short dollar, long commodities, stay with the things we've had. Those have been since June. So again, I get accused of being short term, but I think that's a pretty good call to have been on since June. And it's not about being on the call or making calls or some kind of valuation opinion. It's about getting the cycle right. Full investing cycle, baby. Okay. Quad 2 positioning, 10-year yield goes lower. You know, whether you look at it on real or nominal, I think some people have struggled with that. But just get the direction right, you'll be fine. Long cyclicals against short defensives. Long high beta against low beta on the short side. Obviously, the opposites, long small caps against mega caps. You know, so if you're long a basket of SPACs up until the most recent month where you have to deal with this thing called a drawdown, you know, they've been great. And we think they'll continue to be. Steel producers, metals and mining, equipment services, E&Ps. XOP was for sale yesterday. If you got that, then well done. Straight back up again we go with oil and the XOP or the oil and gas stocks, regional banks, capital markets. It's just a party. Hotels, warehouses on the REIT side. And then we'll talk about home builders. That's one of the red ones here, which is a little different than being long Carnival Cruise or anything really in gaming and leisure. Mr. Steiner, as I affectionately call you, the Stein Bomber, welcome to the macro themes presentation.
Great. Thanks. Thanks, everybody. So, yeah, we thought we'd spend a few minutes here rolling through the $35 trillion asset class that is U.S. housing. And as Keith said, it's been a pretty wild ride these last 15 months. So let's jump into it. So we'll start here on slide 73 with a look at the quads and how housing has fared historically under different quad regimes. So start with the chart on the left here. You know, simplistically, housing generally loves quad 1 and loves quad 4 and hates quad 2 and hates quad 3. That's about as simple as it gets. If we drill down a little bit deeper and get a little bit more nuanced, and we take a look at the chart on the right there, there is a little bit more to it. So when you're in this sort of quad 2 Fed on hold environment or this quad 2 to quad 2 transition environment as we are now, then housing, at least historically, has performed a little bit better. Still not great, but not terrible. So you've had an average return of 3.9% and 2.6% in those environments as compared with just 40 basis points in standard quad 2. So with that sort of in mind, we'll move forward here to the next slide. So before we move forward, I thought we'd sort of take a quick look back at 2020. And what a remarkable year for housing equity price performance. So, you know, it's pretty incredible. In the first half of last year, housing registered both its worst and best quarter of performance in the last 20 years. And you can see that sort of on the right. We've got each year, each quarter mapped out there from a S15 home index return standpoint. And you can see that in the first quarter of 2020, the S15 was down 37, almost 38%. And then in the second quarter, up 57, almost 58%. And if we sort of take a look at the top left there, so in the first quarter of 20, housing was really among the worst performing sectors overall, right there with energy. But then in the next 9 months, the last 9 months of 2020, housing was actually the best performing sector in the broader group. So, just really a tale of two periods. If we go to the next slide here and we look at how housing's been performing so far this year, it's really been a continuation of what we saw in the last 9 months of 2020. So sort of a reversal there of that top left chart on the previous slide. So XLE leading the pack, but right behind it, S15 Home, and then the two housing ETFs, XHB and ITB. And actually, if you look at the right there, you can see that the first quarter of 21 has actually been pretty remarkable in that it's been the best performing quarter in the first quarter in housing's history. So pretty impressive. Fundamentally, if we turn to the next slide, 76, this is our housing compendium table. It's a simple heat map, sort of red. All of it is from a rate of change standpoint. If we went back maybe even just 2 months ago, this entire table was just green. There was almost no red on it whatsoever. And if we think about where we've come just in the last couple of months, we are starting to slow down, weaken on the margin here from a rate of change standpoint. So certainly that's caught our eye. Obviously, we're in this quad 2 environment. And of course, as we'll get to later, rates are rising. As Keith sort of alluded to, there's a lot of positives and a lot of negatives here, and there's been a lot of swings. And I don't think that's sort of shown any better than on this next slide, slide 77, which is really sort of two different lenses. First on the right is the CZ index. As you can see, in the course of 2020, we went from an ATL to an ATH, and now sort of back again towards, sort of close to that zero line. Housing didn't follow that exact same curve, but over the last couple of years, it has. So in the fourth quarter of 2018, it hits all-time low. And just for context, the HSI, or Housing Surprise Index, is structured the same way as the CZ. It's basically a diffusion index that sort of looks at whether or not data is coming in better or worse than expected. And so positive numbers mean it's coming in better than expected, and vice versa. So we went from an ATL, all-time low in the fourth quarter of 18, to an 18-year high in September of 20. And since then, we pulled back into this sort of nether world of zero there. If we look at the progression, next slide, 78, we can see that we really sort of accelerated from 1Q19 through early 2020. In other words, the housing market going into COVID was quite strong and improving from a rate of change standpoint. Then, of course, we hit the COVID cliff in really the months of March, April, and May. And then since then, it's been really sort of this confluence of organic strength, really low rates up until just January of this year, and this whole work from home deurbanization trend, which has driven this massive multifamily to single family transition. So that's kind of the way the data had been progressing. Fast forward to 2021, and we're beginning to see a rate of change decel there. So obviously rates are backing up. Inventory constraints are starting to cap upside in transaction activity. And it's going to get real rocky here because over the next couple of months, we're going to be comping against those COVID cliff numbers. So we're going to see a sharp acceleration. But then as soon as we move beyond those 2-3 months, we're going to start to see things slow down pretty dramatically.
Just to hit on the conclusions here, and for those of you that haven't seen this before, the things I'm adding today are things that I hadn't added yet. It doesn't mean that I haven't added them to real-time alerts or any other product, macro show, et cetera. I've mentioned them. Plenty of them have been mentioned and signaled on. But officially, we can roll the ones that we've had for or introduced in prior quarters into the trending positions. There's nothing that we've had for 3 years because all of our former longs, which include dollars, gold, treasuries, and Utes, are our shorts, which is good. Shows the objectivity and the dispassionate nature of the model. But adding I'm just basically levering up what we already said, which is buying more. And in March we had a buying opportunity in basic materials and oil and gas stocks in particular. To add that to energy, obviously it's very similar. Inflation beneficiaries and broadening the European bet. And then on the China side, that's new. Brazil is probably my least favorite position that I put in there, just because it looks less good than most things, and it has a quad 3 in front of it. And I'm also doubling down on the bet against duration by adding something like extended duration bonds and even the short end of the curve. I got that in there too. Why can't the 2-year yield go up another 10, 15, 20 basis points? What you want on the short side in an environment like this are things that don't go up when everything else is.
Keith, any final words, parting words?
Just stay nimble, and when we think we know, we'll let you know. We got a long history of doing that.